Hello everyone, welcome to chapter 8 of the Exit Cycle. Now, as always, before getting into the details, let's first of all talk about the objective of this chapter. Okay, now the first thing that I'll say is that I know everyone online says that journaling is important and it's the most important thing that you could do in your trading. Okay, everyone says that, and you've probably heard that statement 1,000 times already. But the reality is that most of what's out there about journaling is kind of useless. Okay, it's kind of counterproductive because it's just people telling you to take screenshots of your trades, take screenshots of your charts, and maybe write a line or two about it. And then what? Then what happens is that you just dump it in a folder and then forget about it. Okay, and that's basically you just gathering data, gathering random screenshots just for the sake of it so that you could feel productive. And obviously that's not journaling. Okay, and I'm going to avoid all of that here, and instead this chapter is going to give you an actual and a complete framework. Okay, like a real and a repeatable process and a repeatable framework that you can follow week after week, and one that's effective, practical, and most importantly consistent. Okay, the goal here in this chapter is to help you build a journaling framework and a routine that actually improves your trading, and it's not just something that makes you feel productive. Okay, it's not just something that you do just for the sake of it. Okay, and instead it should be something that actually improves and refines the way you analyze the markets, or the way you take trades, or the way how you behave. Okay, and this whole process, this whole framework is not only going to help you improve your execution and your decision making, but it's also going to improve your discipline over time. Okay, and it wouldn't be just about keeping records or tracking random data or random screenshots. Instead, it's actually going to be about making refinements. Okay, real and tangible refinements, not only in your strategy and your model and your executions, but also your behavior, your mindset, and your psychology. Okay, all of it. Okay, and to do that, I'm going to focus, this framework is going to focus heavily on practicality and consistency. Okay, and by the end of this chapter, you're going to walk away with a journaling framework, a journaling setup, or a journaling routine that actually helps you refine the way how you trade and the way how you behave. Okay, now let's move on to the next slide. So right here in this slide, first of all, I'm going to just list down the components that makes up the journaling framework, and then we'll discuss them in the next slide. Okay, so right here you can see these are the five key components or core components that the journaling framework is going to be built around. Okay, each one of these components has a specific purpose, and together they create a complete feedback loop. Now, what a feedback loop is that it basically is a system where when you give it an input, it actually gives you an output based on that, and it not only evaluates your technical performance but also your behavioral performance. Okay, it basically gives you insight into your system, your edge, your technical edge, your behavioral edge, and gives you insight into how could it be improved in, how could it be refined, how could those things be refined. Okay, so now let's get into the next slide, and let's discuss the first component. So the first component that we have is tracking trades and emotions. Okay, now this is pretty straightforward, and this is basically the foundation of your entire journaling system. Okay, this is where everything starts, and that's because before we even talk about refining our system or improving our psychology or improving our decision making process, before all of that, first of all, we need data. Okay, we need raw data, not just technical but both emotional and technical. Okay, so first of all, we're going to collect that data, right here in this step. Now let's break down what we're going to track or what we're going to collect. The first one is the technical data. Okay, this part is all about the trade itself and the analysis itself. Okay, now regarding that, the first element that you're going to track or collect or gather or write down or note or journal, whatever you may want to call it, is whether the trade that you executed was aligned with the higher time frame bias or not. Okay, this is what we call bias alignment. For example, whether the trade that you executed was in sync and aligned with the daily directional narrative and the daily directional bias or not. Okay, then after writing that down or noting that down, the next element or the next thing that you're going to journal or track is the market context. Basically, you're going to track and journal the analysis that you performed when establishing the market context. Along with that, you're also going to take screenshots of the 4 hour time frame and show the key level in the candle range that you used to frame the trade on the lower time frame. And that's going to be the second element. Okay, and then the third thing is the validity of the trade, meaning whether the trade that you executed was valid according to your model or not. Did it meet the checklist criteria or not? Okay, did it meet the rules of your system or not? Okay, you're going to be honest with yourself here and track that down as well, track that element as well. Then after that, you're going to track the timing element. Okay, and within the timing element, we have three things. First of all, you're going to journal or track the timing of the entry triggers, meaning at what time did the candle range purge or the liquidity purge above or below the candle range occurred, at what time, at which time, I don't know whether to use what or which, but forget about it. At which time or at what time did the key level reaction happen? Okay, so that's going to be the first timing aspect that you're going to journal. Then after that, you're going to journal and track the timing of the entry confirmation, meaning at which time or at what time did the order block formed or the formation of the order block occurred. And then after that, you are also going to note down the timing of your exit. Okay, so these are the three things that you're going to track regarding the timing element. Okay, and then after that we have the activity element, in which basically you track and journal those trades which were valid according to your model, but you missed them because of some reason, and that's also a part of your inconsistency, and that needs to be tracked as well. Okay, and then last but not least, the most obvious out of them all, the screenshots. Okay, you're going to track and journal the screenshots of every trade and every analysis that you perform. Okay, and obviously that's not just for memory, but to actually see the context of your entries, the context of your executions, and the way how you performed your analysis and executed your entries. Okay, that's what screenshots are for. They basically help you visually remember why you acted the way you did, and later it helps in evolving and improving your pattern recognition. Okay, and then after tracking your technical data, we then move on to the second part, which is tracking your emotional data. Okay, now within this part, you're going to track three things or three elements. First of all, your mindset before the trade, meaning what was your mindset before executing the trade. Then your mindset and your emotional state during the trade, meaning whether during the trade or the execution, whether you felt anxious, did you second guess your decision at any point or not, and basically all of that. Okay, and then after that, the third thing that you must journal or track is your reaction after the trade, meaning how did you feel after the trade played out. Okay, and this is just as important as the other two. Okay, regardless of the trade being a winning trade or a losing trade, how did you respond to it? Okay, did you feel guilty? Did you feel fear? relief, or any other emotions, and you're going to write them down in your own words, in your own raw words, and then that's basically going to act as your reflection on how you behaved before, during, and after the trade. Okay, and then you can use that input, use that information, and review it later, and then uh, based on that make adjustments in your strategy, your approach, or your behavior, or the way how you think. Okay, so that is what you're going to track down in the first component of your journaling. Okay, now this first part might seem simple, but let me tell you that don't underestimate it. And the reason is that if you skip this part, if you don't do it correctly and properly, then the other components would become redundant. Okay, so make sure that you track your data accurately and you are honest with yourself when tracking all of these different aspects and elements. Okay, now let's move on to the next slide and let's discuss the second component, which is reviewing your trading data. Okay, so now that you've got all of this raw data and you've recorded it successfully, the next step is to actually make sense of it. Okay, and the next step, we turn these numbers and this raw data into insights, actual insights, which you could then use to make adjustments and refinements in your approach. Okay, this step converts your results into measurable metrics that help you evaluate whether your edge is statistically playing out or not. Okay, now let me explain that to you. So, right here, these are the core metrics that you're going to analyze or that you're going to track. Okay, now each one of them is going to be a direct reflection of your edge, of your execution, and how well you are managing both. Okay, now the important thing here is that you're not just tracking these metrics or analyzing these metrics to evaluate your own personal performance, but also along with that, you're you're going to be analyzing them or using them to also measure how well your model performed theoretically. Okay, not just for your own personal performance, but also for your model's performance as well, your model's theoretical performance as well. And once you've collected both sets of metrics, the actual performance along with your theoretical performance of your model, you will then start comparing them. And then that comparison will eventually show you where your inconsistencies are, the behaviors or the decisions that led to those inconsistencies, and how those inconsistencies and mistakes are directly affecting your overall performance. Okay, and then from there you can use those insights to make targeted adjustments, whether that's in your strategy, that's in your trade management, your risk management, your mindset, your behavior, whatever. And that's what turns this data and these metrics into actionable feedback, actionable and tangible feedback. And that's what leads to actual refinement in not only your strategy, your system, but also your trading psychology, your trading mindset, your trading behavior. Okay, now let's discuss each one of these metrics in detail. The first one that we have is pretty straightforward, which is win rate. Okay, now you know what win rate is. It tells you how often your trades result in a profit or what is the percentage of your winning trades. Now the reason this matters is that if you compare the win rate between your own personal performance and with your model's theoretical performance, then that basically show you the gap between them. Okay, and if your win rate is significantly lower than what your model is designed for or how it performed throughout the week or throughout the month, then that could signal that you are forcing trades outside your system, you are misreading bias or structure, and you are not executing the model correctly, and that could act as a red flag for you that something's off. Okay, and that could point to a misalignment in your analysis or your discipline or your behavior or the strategy itself, and then you could use that as an insight. And then after that, the second metric that we have is the average R, or the average risk reward ratio per trade. And this shows how much you are making or losing on average per trade. And the reason tracking this helps is that it helps you understand, are your winners large enough, and are you managing your trades in line with your strategy or not. And then after that, we have expectancy, which is basically a mathematical formula which evaluates or determines your edge. Okay, this is the mathematical foundation of your edge, and this is what tells you statistically whether your trading is profitable or not, or whether your edge is profitable or not over time in the long run. Okay, and the reason we track this element is that it helps us understand that even if we are profitable in the short term, if our expectancy, if the expectancy of our edge is negative, then that's not sustainable, and the strategy itself or the system itself is unprofitable or is going to be unprofitable in the long term. Okay, this metric basically gives you a clear yes or no answer. Okay, whether it answers whether your edge actually works or not. And then after that, we have drawdown and recovery. Now, the drawdown has two parts, absolute drawdown and relative drawdown. And it basically shows you the depth of your losing streaks, or when you go on a tilt at a certain time. And recovery tells you how fast you bounce back from those, from that drawdown and from those losing trades. And both of these two elements together, they expose how vulnerable your approach or your edge is during such market phases or during such drawdown periods. Okay, now the key thing here is that if your recovery takes longer than the drawdown itself, then that could be a problem. That could mean that you are overexposed on losses, your wins are not strong enough to bounce back, and you're not managing risk consistently. Okay, and tracking this metric gives you uh, a real picture and an accurate picture of your of the resilience of your edge and your approach. And then after that, the next and the fifth metric that we have is equity curve consistency. Now, in my opinion, this metric right here is one of the most important metrics for long-term success. And the reason I am saying that is because the truth and the reality about profitability is that it's not just about how much profits you make at the end of the week or at the end of the month. It's rather about how you got there. Because you could have two types of equity curves. You could have a smooth equity curve or a volatile one. Now, those both of them may end up in profits. For example, a volatile equity curve in which you have violent swings up and down may still end up in profits. But that kind of curve, that kind of volatile curve, is a clear sign of instability. It clearly shows that either you are emotionally unstable or you are strategically unstable in terms of your technical edge. Okay, and on the other hand, if you have a smooth and a steady equity curve, even if it ends in a smaller profit as compared to the other one, it's often a better thing. Okay, because it shows that you have consistent execution, it shows that your risk exposure is controlled, it shows that you are disciplined in your trade selection, and it shows that your long-term sustainability would be much stronger as compared to the other approach where you have a volatile equity curve. Okay, so when you are reviewing your journal and your metrics, this part is extremely crucial. Okay, so these were the metrics that you're going to analyze using the data that you collect in the first component. Okay, and just like I told you earlier, you're going to also perform a comparative analysis on all of these metrics. Okay, you're going to compare your actual performance versus against your model's theoretical performance. For example, let's say that on a week, if your edge averages a 2R, but you are only producing a 0.5R that week, then that shows that there's inconsistency between your performance and your model's actual performance. And then that shows that the problem isn't in the system, it's in your execution. And then what you could do is identify the root causes of those inconsistency, or the root cause of that inconsistency, and then you could find a solution for that inconsistency and make refinements and adjustments. Now let's move on to the next slide and let's discuss the next component, which is reviewing your emotions and mindset. Now at this point in your journaling process, you're going to step away from all of the numbers and metrics, and you're going to move into something that's a little more personal and a little more behavioral. Okay, at this point in your journaling process, you're going to shift from quantitative analysis to qualitative analysis. Okay, you're going to shift from what the statistics are telling you to understanding and knowing why those statistics and why those numbers even exist in the first place. Now what you're going to be doing in this phase exactly is that you're going to be reviewing your emotions, reviewing your mindset, and reviewing your mental patterns. Now, the main reason behind that is because most of our losses don't come from our system being wrong or our technical edge not playing out, but instead they come from our decisions, our reactions, and our impulses. And if we are not tracking these behaviors, these reactions, and these impulses, then obviously we're going to then miss half of the picture. Okay, and that's why, for that reason, it's also important for us to review our emotions and our behaviors as well, so that we could find out the emotional triggers and the behavioral patterns that leads to the inconsistencies in our performance. Okay, now right here, let's talk about what to identify in this component. So first of all, we've got emotional triggers. Now in this part right here, you're going to identify the emotions that caused most of your losses. Okay, you're going to identify whether it was FOMO, the fear of missing out, greed, impatience, or revenge mentality, or any other emotion. Okay, and then after that, we've got behavior loops. Now, let me first of all tell you what behavior loops are. Behavior loops, now think of behavior loops like mental cycles that keeps repeating. Okay, it's when your brain falls into a trap when one bad action triggers another. Okay, and then that second action reinforces the first one, and then that way you are then stuck in that cycle, in that loop. It's like a bad habit, and it's not a random one, it's patterned, and you could actually identify it and then get rid of it. Okay, that's what a behavior loop is. Now, a classic example of a behavior loop in trading is, for example, you take a loss, and then because of taking that loss, you feel pissed, you feel left off, or you feel that you're not doing enough. And then you instantly look for another setup. And even if you know that it's a trash setup, it's not worth it, you still execute that trade because you want to make back the money that you lost with the other trade, with the other losing trade earlier. And obviously you're not thinking logically anymore, and you've just forced a trade, and then you lose that trade again, and now you're down 2 hours instead of 1 hour, and the loop repeats itself. Okay, that's an example of a behavior loop. Okay, you take a loss, and then because of that loss you revenge trade, and then due to that revenge trade you take another loss, and that is an example of a behavior loop. Okay, now another example of a behavior loop is when you miss a trade because of fear or because of second guessing your model, and then because of that loss you then reinforce FOMO, and then because of that FOMO you take a bad entry, and that ends up being a losing trade. Let me explain. Let's say that you are watching the charts and the market presents an opportunity. The market presents a valid trading opportunity. It presents a trade, and it's a valid trade according to your model. Now, in this case, what happens is that instead of actually executing that valid trade, you hesitate, or maybe you second guess your decision or your model. Okay, because of your emotions, you avoid executing that trade, and then you watch that setup pass without entering and you miss it, and then it flies without you and it ends up being a winning trade, and now you feel left behind. Now you feel guilty, you feel like a piece of shit because you missed that valid trade. Okay, even though that was a valid trade according to your model, because of some emotion, because of maybe fear, because of hesitation, you missed that trade, and now you feel left behind, and because of that you start feeling FOMO. You start feeling like you are missing out. You start feeling like you are missing out on profits. And because of this new emotion, because of this new emotion of missing out that got reinforced because you missed a trade, which was because you felt afraid and hesitated and second guess your decision. And because of this whole phenomena, because of that, you took an invalid trade because you felt FOMO. You took a late entry because you wanted to make up for the missed trade. And obviously, what ends up happening is that you lose that invalid trade again, and now you feel even more shitty. You feel even more guilty because instead of actually being in profits, if you had just avoided the emotions to influence your decisions, instead of actually being in profits, you're not just in break even, but in a loss. And all of that was due to the fact that you were stuck in this behavior loop. And the behavior loop here is that you, first of all, let emotions dictate and influence your decision making, due to which you miss that trade. And then, because of missing that trade, it reinforced another emotion of FOMO, another emotion of fear of missing out, which in turn dictated another bad decision, another bad action of taking an invalid trade, and that led to even more emotions. So now you are stuck in this loop. Okay, this is what I call a loop. This is an example of a behavior loop where an emotion reinforces a bad action, and then that bad action reinforces another bad emotion, and everything starts to fall apart. Okay, and obviously the important thing is to avoid getting trapped or getting stuck in these behavior loops. And the way we can do that is by tagging our trades with small notes and small stickers with what happened before them emotionally, and which emotions dictated and influenced those decisions or that decision. And then that way you'll start seeing these loops in your own data. Okay, you'll start spotting patterns within these loops. And then after that, you could then find solutions or coping mechanisms for it to actually deal with it in live market conditions. Okay, and then the next metric that we have is performance states. Now, the way I would define this term is that basically a performance state is the mental or the emotional gear or the emotional state that you're operating in when you execute a trade. Okay, now you've probably noticed this yourself, that some days everything feels clear to you, you are calm, your focus is sharp, and on those days your trades are clean, your execution is accurate. Okay, and then on other days your brain feels foggy, you're second guessing every decision, and on those days your execution is all over the place. Okay, it's not as accurate as the other days. Now, what that means is that there is a difference between the performance state or the emotional state on each one of those days. Okay, or you could say that on each one of those days, your performance state or your emotional state or your mental state that you were operating in was different. Now, the reason this matters is that if you could identify which emotional state or which performance state gives you the highest performance, if you could identify that, then you can recreate that performance state on demand. For example, let's say you've realized and you've found this pattern within your execution, that most of your wins or 80% of your wins came from when you were calm before the execution, you were fully alert, you were not distracted, and your focus was sharp. Okay, if you found this pattern within most of your winning trades, like 80% of your winning trades, that you are operating within that specific performance state, then that shows you that it wasn't just a coincidence that when you were calm, when you were fully alert and you were focused, most of your trades ended up being winning trades. It shows you that that wasn't just a coincidence, but instead it was a direct result of you operating within that specific performance state. Okay? So, what you're going to do is that you're going to take this idea and use it to your advantage. For example, you're going to build protocols, you're going to build certain routines and rituals which will trigger such a state of performance or such performance state before you execute or before your session begins. Okay, for example, before your session begins, you're going to do some breath work, you're going to review your model, you're going to cut distractions and journal your emotions. And when you follow all of these protocols, you will enter that specific type of performance state where you are calm, you are fully alert, and you are focused. And on those days, your executions would be much more accurate. Okay? On the other hand, on the other side, let's say you've noticed that every time you felt tired or you haven't had proper rest or you were in a rush, when you were in that sort of a performance state, on those days you made impulsive entries, you missed trades, your execution was inaccurate, and that sort of performance state led to 80% of your losses. Then that also shows you that that wasn't just a coincidence, but instead your losses or your execution being inaccurate on those days was a direct result of your performance state, of you being tired, not having proper rest, and being in a rush. So that's another data point for you. And now you are aware, you are conscious of the mental state or the mental capacity or the performance state that led to most of your losses. And what you could do about that is you would build certain protocols to avoid that performance state, to avoid that mental state. And you're going to build safeguards. For example, you could build a protocol like, if I am in a rush and I haven't had proper rest and I'm feeling tired, then on those days I'm going to avoid trading as a whole, because your data has shown you that most of your losses came from days where you were in that specific performance state. Okay? This is how this metric is going to help you in your trading and your execution. Okay? So these were the three metrics that you're going to analyze or identify when reviewing your emotional and behavioral data. Now, the way how you're going to do that is by tagging your trades by emotions and then looking for repeating patterns within them. For example, every time you take a trade, you are going to tag it with three types of emotions. First of all, your emotional state or your emotions before you executed the trade or before your execution, and then your emotional state or your emotions during the trade, and then your reaction or your emotions after the trade played out. Okay, and these tags will help you identify or analyze the three metrics that I just explained to you. Okay, now I know it may seem too much of a work for you, or you may think it's going to take the whole day if I just sit down and write about my emotions. But trust me, it's so easy. Okay, you just have to make up like at least 5 minutes at the end of each day, and then quickly tag each one of your execution with your emotions. And trust me, it doesn't take more than 5 minutes. Okay, and the important thing here is to be honest with yourself. Okay, is to the important thing is to be brutally honest with yourself, because if you are inaccurate with the notes or the tags, and you don't write the actual emotions because you feel ashamed, then all of this would be useless. Okay, the only way it will work is if you are brutally honest about yourself and about your decisions and about the emotions that led to those decisions or that influenced those decisions. Because trust me, I've been there. Okay, I've been through that phase where I would make such emotional decisions and such out of pocket and ridiculous and childish decisions that then I'd literally feel ashamed. I would feel like I'm the biggest piece of shit and the most childish person ever. And then due to those emotions, I would just avoid writing down my emotions in my own words, in my own raw words, because I would think that that acts as a reminder of my bad emotional decisions. And obviously, not being honest on those days did not help me at all. And the only time I actually started making improvements and actually started dealing with those emotions is when I was honest about everything. Okay, when I was honest about my emotions and didn't sugarcoat anything. Okay, so I know some of you might avoid journaling your emotions on your worst days, on days where you make such childish and ridiculous decisions. But trust me, do not make that mistake. Okay, and actually be brave and write down your emotions in raw words. And it doesn't matter if those were childish decisions or emotional decisions. Okay, write them down at the end of each day, and you may feel ashamed or even guilty when writing them down. But trust me, it's completely worth it. It's all worth it, because then that way you'd be actually able to use that to your advantage, find patterns within your emotions, and then get rid of the bad ones which leads you to making emotional decisions, and reinforce the good ones that leads to most of your winning trades or leads to accurate execution. Okay, now let's move on to the next slide, and let's discuss the fourth component, which is summarization. Now at this point, you've already tracked your trades and tracked your emotions. You've then reviewed the data, the technical data, and both the emotional data. Now in this step, you're going to bring all of that together, and you're just going to summarize all of that data so that you could actually understand it better. Okay, this part right here is going to be a bit more personal. Okay, and this part, what you're going to do is that you're just going to reflect on everything. Okay, you're going to interpret all of the data, all of that technical and emotional and the behavioral data. You're going to interpret that data in your own words. Okay, in your own language, you're either going to record a short clip or write down everything about your trading week, both regarding the technical part of your edge and the behavioral part of your edge. You're going to basically break down everything uh, by being as honest as you can. Okay, and it's not just going to include the behavioral part of the edge, but also the technical part. Okay, and within that summarization, you're going to include stuff like how did I perform, how did my model perform, were there any inconsistencies between those two performances, and what led to those inconsistencies, what decision led to those inconsistencies, were my trades aligned with the higher time frame directional bias in the intermediate time frame context. Okay, you're going to basically talk about all of these things in your own words. Okay, and the goal here is not to sound smart. Okay, it's just to understand yourself better and to be much more self-aware of your system and your edge. Okay, you're going to talk about all of these different elements of your approach or these different questions regarding your performance. Okay, and what this step does is that this step creates awareness. Okay, this step will create awareness in your mind, and then that awareness will actually lead to growth. And then you would actually use this awareness and the next step and the fifth step and the fifth component, and you would use it to build refinements. You would use it to improve your approach, make adjustments in your approach. Okay, you would use this awareness to build such protocols which will overcome the bad aspects of your approach and reinforce the good aspects. Okay, now let's move on to the next and the final component, which is refinement. Now, this is the final step right here. This is the final and the most important and critical stage of your journaling. Now, up until now, everything that you did in the previous steps or the previous components was all about building awareness. Okay, tracking data, collecting data, analyzing it, reflecting on it, all of that. Okay, but now you actually take that awareness and turn it into action. Okay, you build systems around it, you make adjustments, and you refine your edge. You refine both your technical edge and your behavioral edge. Okay, in this stage you actually build protocols and guidelines so that you could solve the weak spots and reinforce or enhance the strong spots, or you could say the strong aspects of your approach. Okay, so now let's talk about how you're actually going to do that. Now, this right here is the exact step-by-step framework that I personally use to create or build refinements and adjustments in my approach. Okay, now within this framework, what you're going to do first of all is identify the weak spots. Okay, now this part's easy because technically you would have already done that in the last step. Okay, you would have already pointed out or identified the weak spots and your approach in the last component. For example, maybe you noticed or you found out or you identified this pattern that you keep getting emotional after losses, and then because of that emotional trigger you then overtrade or you take invalid trades, and that is an example of a weak spot. Or maybe another example would be that you start overtrading or you start taking invalid setups when you see price forming a big candle or when you see a candle expanding, and in that case you start feeling FOMO, you start feeling like you're going to miss out on profits, and then because of that you take invalid trade, and that is an example of a weak spot. Okay, now whatever it may be, whatever the weak spot may be, the first step is just to identify these weak spots. Okay, now for each one of you these weak spots might be different. Okay, these weak spots are going to be different for each one of you. And then after that you move on to the second step, which is to build protocols. Okay, now that you've identified the weak spots, you can't just say that, okay, I've identified this weak spot and I'll try not to do this again the next time it happens. Okay, because that's not how it works. You can't just do that and expect the problem to be solved. Instead, what you're going to do is you're going to build a systematic protocol to intercept that behavior the next time when it happens. Okay, and to build that protocol you're going to use the if and then framework or the if and then logic. Okay, if X happens then I do Y, and that basically acts as a protocol for you, a systematic protocol for you. Now an example of this would be that, let's say, if I feel FOMO when I see a candle expanding or when I see a big candle forming, and I feel FOMO, then I pause the charts and wait for the next 15-minute candle to close before making a decision. So now right here in this example, you can see that whenever you start feeling FOMO, okay, whenever you start feeling like you are missing out, and that could potentially lead to a bad decision of taking an invalid trade, you intercept that behavior in live market conditions by pausing the charts and waiting for the next 15 minutes for that candle to be closed before making any decisions. Okay, so now you've intercepted that behavior. Okay, another example would be that let's say that you have this weak spot where after taking a loss or taking a losing trade, you start over trading after that and you start taking invalid trades because you think that you're not doing enough and you want to make back that loss. So now in this case, what you could do is build such a protocol where you could say something like, if I lose a valid trade, then I stop trading for the rest of the day. Okay, so right here you can see that it actually saves you. If you follow this protocol, it saves you from making any other emotional decision or from taking an invalid trade. So these were the examples of building protocols. Okay, then after building the protocols, you then move on to the third step, which is to integrate those adjustments, which means that now that you've actually built the protocols, in this step you actually plug those protocols or add those protocols into your trading routine or your trading plan, which basically means updating your checklist, updating your rules, writing it down in your pre-market session journal, and reviewing these protocols before you execute or before the session starts. And then the next step is to test these protocols. And you're going to test these protocols not just the next week or the next month, but also using the past data that you would have collected. Okay, you would use these protocols on the past data, on the past trading data, and you're going to see and basically evaluate whether if you had used these protocols in those instances, in those cases, whether you would have got saved or not, or whether the weak spots or the problems would have gotten reduced or not. Okay, and this step you're going to basically verify these adjustments to see if they actually fix the issue or not. Okay, this is going to act as a feedback loop for you where you're not just building these protocols but also testing them actively, not only through the past data but also the future data, and then adding it to your system once you've successfully verified it. Okay, now right here we've got these two examples that I've written down. Let's go through them before I wrap up the chapter. Okay, the first example here is that if you keep entering before confirmation, let's say your weak spot is that you keep entering before confirmation, which basically means that you don't wait for an order block to be formed before entering, and maybe that happens because you start feeling FOMO. Now to solve that problem, the protocol could be that you create this protocol and you add this protocol to your checklist, which is a trigger, then confirm, and then execute protocol. Now what this protocol means is that basically before executing, you're first going to wait for an entry trigger to be formed. And only when that entry trigger has formed at the right time, at a key time, then you're going to move on to the confirmation part of this protocol, which basically means you're going to wait for a proper order block to be formed at a key time, and only then you're going to execute your trade. Only then you're going to move on to your execution part. Okay, so this protocol right here would save you from premature entries or premature executions. Okay, and if you correctly follow this protocol, every single one of your trade would be a valid trade where it has not only the proper entry triggers, but also the proper confirmation at a key time. Now, another example would be that let's say you have this issue or this problem where you keep re-entering invalid trades after you take a valid loss. Now, in that case, what you could do is create this protocol where you have this one trade per day rule or this one trade per day restriction. And by actually using that protocol, it's going to save you from those unnecessary invalid losses. Okay, and these two examples right here that you can see that I just explained are actual protocols that I personally use myself. Okay, this final refinement stage or refinement component is where you actually start closing the gap between who you are as a trader right now and who you are trying to become. Okay, and this component you turn the self-awareness into self-mastery. Okay, and that's how you evolve and improve as a trader. Okay, so that was the whole journaling framework that I personally use.